Welcome to Deal Mechanics, the seventh and final course in the Bulletproof Pitch curriculum. There are 7 modules in this course. Let's start with the deal after the deal. If you followed the curriculum to this point, you've built the narrative, constructed the deck, prepared the financials, organized the data room, launched the outreach, and navigated the live pitch. Now comes the moment that determines whether all of that work pays off and how much of it you get to keep. Here's a story that happens more often than it should. A founder closes a seed round at a valuation they're proud of. The number looks right. The capital is in the bank. They announce the round, get congratulated, and move forward. 18 months later, they go to raise a Series A. The market has shifted. The new round comes in at a lower valuation than the seed. And now, the anti-dilution clause in the seed term sheet triggers. The seed investors get repriced. The founder's ownership drops significantly, not because the business failed, but because a clause they did not fully understand at the time was designed to protect the investor in exactly this scenario. Or a different version. The founder gave the seed investor participating preferred, which seemed standard at the time. At exit, the investor gets their money back first and then also converts to common and takes a share of everything that remains. The founder and early employees receive far less than the headline numbers would suggest. In both cases, the problem was not the business, the problem was the deal. Most founders optimize for valuation because it is the most visible number. It is a number they announce, the number that signals market validation, the number that peers measure themselves against. Everything else in the term sheet feels like legal language to be reviewed by a lawyer and signed without much interrogation. That instinct is exactly backwards. Valuation is one variable in a system of interconnected terms, and it is often the most consequential one. There are 5 reasons why optimizing for valuation is a trap. Difficulty raising the next round. A high valuation today sets the floor for the next one. If the business has not grown into it by the time you go back to market, you face a down round. The signal that sends is nearly impossible to walk back. And then we have unfavorable terms in exchange. Investors protecting a rich entry price negotiate harder on everything else. Option pool shuffles that dilute you before the money arrives. Liquidation preferences that get them paid first in any exit. Participation rights that let them collect twice on the same dollar. Investor quality trade-off. Optimize for valuation and you optimize for whoever will pay the most, not whoever is best positioned to help you. The right investor at a lower number is often worth more than the wrong one at a higher number. Longer negotiation cycles. High valuations attract scrutiny, and scrutiny takes time. Months spent closing a round are months not spent building the business. Finally, employee expectations. Your team sees the number, they anchor to it. A flat or down round is not just a financial event, it is a morale and retention problem you will have to manage from the inside. Valuation matters, but it is one input. Negotiate the whole document. But to negotiate a number, you have to know how the number gets set. That is module 2 in this course. The terms that matter fall into 2 categories, and each one compounds forward. The first category is economics. Liquidation preferences determine who gets paid and in what order at exit. Participating preferred means the investor takes the money back first and then converts and takes a share of everything remaining. Anti-dilution provisions determine what happens to founder ownership in a down round. Option pool sizing determines how much dilution the founder absorbs before a single new share is issued. The second category is control. Board composition determines who votes on major company decisions. Protective provisions determine which actions require investor consent. These clauses define the power dynamic between founder and investor for the life of the relationship. What most first-time founders miss is how both categories compound. Every term signed at seed becomes a starting position for the Series A negotiation. A Series A investor will look at what the seed investor received and calibrate their ask accordingly. If the seed deal included participating preferred, the Series A investor will expect it. If it included a full ratchet anti-dilution, they read that as either a weak negotiating position or a sign the founder did not understand what they signed. Neither signal helps. Nobody teaches founders this before they sign. The deal you close today is not a single transaction. It is a foundation for every deal that follows. 3 things govern a deal that sets you up rather than constrains you. The first is choosing the right lead investor. The lead writes 40 to 50% of an early stage round, takes a board seat, and sets the terms that the rest of the syndicate follows. Choosing a lead on check size alone is one of the most expensive mistakes a founder can make. The right lead has stage expertise, sector knowledge, a portfolio track record that demonstrates they have supported companies like yours, and a network that opens doors to the Series A. What happens after the deal closes? Board participation, strategic guidance, introductions is often worth more than the capital itself. The second is understanding the term sheet completely, not the headlines, every clause. What each term means in practice, what it costs you as a founder, and what it controls. Liquidation preferences, anti-dilution, board composition, protective provisions, vesting, option pool, each one has a specific impact on your economics and your control. Knowing where to push back and where to accept is not about being adversarial. It is about entering a long-term partnership with clear eyes. The third is maintaining a clean cap table. A cap table that is current, well-structured, and tells a clear story gives future investors confidence that the company is well managed. A messy cap table, dead equity from departed founders who never vested, over-allocated advisor shares, convertible instruments creating hidden dilution, missing documentation, signals the opposite. It is one of the first things a Series A investor reviews, and if it creates concern, the conversation often ends before the deck is even opened. The sustainable packaging company closing a $2.5 million seed round. 2 versions of the same deal. In the first version, the founder closes at a $15 million pre-money valuation. The headline feels like validation, but the term sheet includes 2x participating preferred, full ratchet anti-dilution, a board seat for the lead investor with broad protective provisions including veto rights over any new debt or equipment financing, and a 25% option pool carved entirely from the founder's pre-money ownership. 18 months later, the company needs to raise a Series A. Production scale-up took longer than projected. The new round comes in at a $12 million valuation. The anti-dilution triggers. The cap table shifts dramatically. The founder enters the Series A negotiation owning significantly less of the company than they expected, with a board structure that gives the seed investor effective control over the next financing. In the second version, the founder closes at a $10 million pre-money valuation. Lower headline, but the terms are clean. 1x non-participating liquidation preference, broad-based weighted average anti-dilution, a 2-to-1 founder-friendly board, a 15% option pool, and no restrictions on equipment financing or production debt. The lead is a climate tech fund that has backed 2 materials companies through the manufacturing scale-up phase. They introduced the founder to 3 Series A firms within 6 months. When the Series A conversation starts, the cap table tells a clean story. The terms are standard, and the board structure signals a well-managed company from day one. Same amount of capital, same business, one deal constrained every negotiation that followed. The other created the conditions for the company to raise from strength. The pitch gets you to the term sheet. Deal mechanics determines what happens after you sign it. In the modules ahead, we are going to work through every element of the deal. You will learn how to value your company, evaluate and choose a lead investor, how to build and maintain a cap table that signals professionalism, how to read and understand every clause in a term sheet, which terms to flag and which to reject, where negotiation room exists, and what a winning deal actually looks like. not in headline terms, but in the terms that compound forward into every round after this one. The goal of this course is not a signed term sheet. It is a deal that gives you capital today and strength tomorrow. So let's build it.